So I'm working on a video. It's just taking me a long time to get through it. I'm trying to explain different financial terms, like those terms you hear and you think you know what it means, but you're not really sure. Like, how do you define it? In this presentation, there's going to be the Fed funds rate. We're going to talk about CPI, unemployment rate, and GDP. Because these things are interesting, I think, to me at least. But if you ask somebody like what is the CPI, like they might know it, but I think a lot of people would have a hard time defining it. Same thing with the unemployment rate. Like it seems logical what it is, but it's actually, to calculate it, it's not that straightforward. So that's kind of like the idea of this presentation. So I'll just go through it. This is just practice for me. Maybe I'll come up with more ideas. I think I talked about this last time, but I'll just go through the first two, which is the Fed funds rate. And then there's some new slides. So the Fed funds rate, it's really the purpose of it is so the Federal Reserve can guide the economy. And that's what keeps us from, as a country, from getting too out of whack, keeping us stable. Just like any business, you want to keep a business stable. You don't want it to go bankrupt, right? Same thing with economy. You don't want things to get out of hand where everybody goes bankrupt, people lose their jobs. So the Fed tries to stabilize things. So when the Fed adjusts the Fed funds rate, that affects a lot of things, like the interest rate in your savings account, the rate you pay on credit cards. If you want to get a mortgage for your home, it's all tied to the Fed funds rate. So usually the Fed lowers the rates, and the reason they lower it is to stimulate the economy, because when they lower rates, it adds money to the economy. Banks can offer loans at lower interest rates when the Fed lowers their key guidance rate. So obviously, lower interest rates are more appealing to people. So if a bank is offering a personal loan to you, a $10,000 loan, if the bank says we're going to offer it at 10%, you might think that's a little high, or maybe it's a good rate for you. But if you go back a week later and they drop it from 10% to 8%, it's more appealing, right? The lower the rate, the more appealing the loan is. Could you imagine if you got a 0% loan and people would be taking loans all the time? And this leads to big purchases when loans have lower rates and people are more likely to buy a home, car, businesses, etc. So it's good for the economy. Lower rates are good for the economy. So why ever raise the rates? Well, inflation. That's the main reason to fight inflation. So if inflation is getting out of whack, things are getting too expensive, then the Fed raises the interest rates, and this slows the amount of money circulating in the economy. It drives demand down, because some countries and historically definitely have crazy high inflation. It's so high that the government can't even print enough money. The money is getting almost useless day after day. That's how ridiculous inflation is. I remember seeing a scene in Germany around the World War II time, when inflation was really high, that someone wanted to wallpaper their home. So they did it with currency, because it was cheaper, the currency, to wallpaper their homes than actually use the money to buy wallpaper. That's how bad inflation got. I don't know if that's a true story, but that always stuck out in my mind. And this is the Fed lowered interest rates a lot. They were cutting rates every single quarter, it seemed, right after the pandemic. They had 11 rate cuts. Inflation was 9% a couple of years ago. They brought it down to 3.4%. And historically, you can see rates are all over the place. Look at it. it's just crazy to imagine that the Fed funds rate, which is like the lowest rate, like nobody can get a rate as low as a Fed funds rate except the bank. They were like 20%, which is ridiculous. Could you imagine who can get a home? Who can get anything? Everything had to be cash because you can't even. Could you imagine paying 20% interest on something? You would never ever pay it off. It would just always be out there. And remember, for a while, rates were almost zero. Real recently, but rates aren't fixed. So if you get, for instance, if a bank lends money to you to buy a home, they may charge you 6%. But that doesn't mean everybody who wants to take a home loan has to pay 6%. Maybe your neighbor pays 7% or 5%. Because for every loan, there is some probability the borrower will not pay. So that's why banks and financial institutions charge interest to compensate for that risk. And obviously, the higher the interest they charge, the more risky the loan is. And if the loan is too risky, if you're a really, really high credit risk, you just won't get a loan at all. There's no percentage they can charge, because if you don't pay it back, even if they charge 1,000,000%, it doesn't really help them. The discount rate is the other common rate used. And this is probably something most people don't know. And I'm not even sure if you really need to know it, but I think knowing these things can only help you. So the two big rates out there are the Fed funds rate and discount rate. The Federal Reserve sets both rates. And discount rate is usually, it should be higher than the Fed funds rate, because the Fed funds rate is the rate that banks use to lend to each other. Because banks do lend to each other, especially really big banks help the smaller banks. So if a bank needs money to fund, maybe to fund a loan or to fund deposits, they may borrow from another bank, and the other bank charges them currently 5.33%. What did you learn? Where did you learn finance? A lot of it on here, actually. But it's kind of like just a progression over time. It's just little by little. I just kept learning and then making mistakes, and then trying to, like, Investopedia helped a lot when I was trying to really learn about financial statements. And I would Google a term. Investopedia is very clear, so that's why I say that. Like Wikipedia, it's very kind of like, it's dense, and it's hard to really, it's a good site, but sometimes it's hard to get a clear answer. It's just very, it's too complete almost. It's not kind of as user friendly as Investopedia. Been following you for years. I appreciate that. Berkshire A did well for you. Yeah, it's doing well. It's a great company. It's kind of like, it's a dummy way to invest. Just invest in Berkshire Hathaway. Let him manage your money. He's the only financial advisor I would give my money to. So right, the Fed funds rate is the rate banks lend to each other. And the Fed funds rate is tied to the prime interest rate. So usually if you get a loan, you're not going to pay 5.33%. And there was a time the Fed funds rate was like 0.5 of 1%. So no one's going to get a loan. Even when Fed funds rate was zero, of course you can't get a loan for zero. The banks were lending to each other for pretty close to zero. But you couldn't get a loan for zero. You get a loan for, like, they call it prime. They go prime plus 2%. So you'll get a loan for a few percentage above prime. And as you know, it's tied to all loans. So there's a lot of different rates out there. There's a million rates. Your credit card rate, your mortgage rate, your everything. But they're all kind of like, they all lead back to these two. The discount rate is the rate the federal government lends to banks. The federal government is also known as the central bank. It's kind of like the last resort. The government doesn't want to be lending money to banks. That's why they make the Fed funds rate lower, so it's more appealing for a bank to borrow from another bank than from the government. But if other banks are not willing to lend to a bank, the government doesn't want banks to collapse. That's a huge problem when banks collapse. How long can Berkshire go up? Well, I mean, he just picks the stocks. He doesn't run the companies. It's just like any company could just keep going up as long as they stay in business. And a lot of companies will go bankrupt. And the good thing about Berkshire is that even if the companies he's investing in go bankrupt, as long as it's not a big percentage of his portfolio, it's fine. It's just like investing in an index. The S&P 500 will never go bankrupt unless the U.S. economy goes bankrupt and we're all poor and desolate and the world's ending, which is not going to happen. So the Federal Reserve sets both these rates. Like I said, I don't think you need to know this to invest in the stock market, but knowing these kind of things just make you a more informed investor. And when you're reading things or listening to people talk about investing, if you don't know what stuff like this means, it makes it hard to focus on a conversation because they say something, you don't know what it means, so you hang on to those words they're saying, and you're not even listening to the next few sentences because you're still hanging on to the stuff you didn't understand. And then you just stop focusing totally because you're just not absorbing anything. So these kind of things just give you a full picture. You just won't get a dividend, but you will make a ton by holding. You won't make a dividend, which is fine. I mean, if you're looking, dividend is just, you could just sell the part of the stock. If you buy $10,000 of a company stock, if you want a dividend, just sell the stock. Sell maybe 10% of it. That's the same thing as a dividend. If you're looking to get money back. And when a company pays a dividend, doesn't mean the stock will go up or down. I don't really read many books. I find them pretty boring. I have a much easier time. I do like to read about things, but I have a much easier time. Like if I try to learn about the financial statements, and then I see a term I'm not too familiar with, like if I see deferred tax asset, I'm not really sure what that means. I'll go and I'll read about what deferred tax asset is, and I'll watch a few videos. I find that much more interesting than reading a book. Reading a book where I just half the time I'm reading the book. I'm just thinking about something else while I'm reading the book. Like, I don't know if you ever try to learn like a sport or try to learn how to ride a bike. Just read a book. You won't learn anything by reading a book. If you want to learn how to practice a language, if you want to be good at speaking a language, you want to be in good shape, you want to be good at investing, read a book. But you don't really get anything out of it. You have to kind of like participate in something to learn it. Like you won't learn how to play baseball unless you play baseball. You could read a book once you understand the basics and try to learn some new tricks to playing baseball and then apply that. But so that I don't really, unfortunately, read many books. I find them kind of boring. So I added some more slides to this presentation. So the CPI, Consumer Price Index. So it's a measurement of the change in prices, like on a basket of goods and services. You've probably heard that term before. So this is how they track inflation. The Fed uses the federal funds rate. They raise it. They raise the federal funds rate to fight inflation. But the way they calculate inflation is based over the CPI. Because you could think of the Fed funds rate as a tool, just like you could think of as a car, as a car is a tool to get to somewhere. You can use a bike to get somewhere. You can use an Uber, you could use a motorcycle, you could use a plane. It's just a tool to get there. But the way they actually calculate inflation is based over the CPI. It's pretty simple. They just look at what the CPI was previously, what the CPI is currently, how much it went up. If it went up 5% or 10% or it went down, that's how they look at inflation. Because if it cost you $10 for a burger last year, now it's $12, your burger's 20% more. But you have to look at maybe lots of different things, not just burgers. So the target inflation rate, the U.S. government, 2% is like the target. So if inflation is getting really high, like it's 7, 8, 9%, then the Fed will enact expansionary policies, meaning they'll lower interest rates, which adds money to the economy when you lower interest rates. Or contractionary measures, which is raising interest rates. They do other things too. They buy debt, which when the government buys debt, that's adding to banks' balance sheets. Or when they sell debt, that's taking money off of banks' balance sheets, taking money out of the economy. And the way they calculate the CPI, it's based on 80,000 price quotes. So they may survey, I'm just making this up because I'm not sure exactly how you do it, but they may send a survey to McDonald's and what are the prices of these items? And they may send a survey to, a carpet store and a survey to a pet store. So they get 8,000 price quotes from 23,000 retail and service establishments. And they also get price quotes from 50,000 rental housing units. So they get these quotes, just like you do it on a much smaller basis because you're paying for certain things every single week or every month. So over time how much your electric bill went up. Over time how much it cost you to buy your favorite cereal or to go to your favorite restaurant. So you can kind of see it. But it's not as complete because you have a subset of things you buy where this is based off of kind of like our entire economy, our entire world. So it's a measure of our purchasing power. So if the CPI goes up a lot, our purchasing power is now declining because say you make $50,000 a year, right? And a new car costs $20,000. Now next year, let's just pretend you still make 50, like income didn't go up. But cars are now, the average car is now went up from $20,000 to $30,000. So you're still making the same salary, but cars went up 50% from $20,000 to $30,000. So your purchasing power has gone down drastically. So people adjust for these things. If things are getting more expensive, you just don't buy those things, or you look to alternatives. You can easily. There's a lot of alternatives for cars. You could buy a cheaper car. You could lease a car. You could not even get a car. You can walk to work or Uber. Other things, it's hard to get alternatives like medicine. Certain medicines, not many alternatives for, unless it's a medicine that you don't really need. But if it's like a life-saving type of medicine, that's called what's it called? Elasticity and elasticity, which I probably should put in this presentation actually, because that's probably another good term. So the CPI is this was from 2023. I found this chart on I think the government's website. So they look at 8 groups to measure inflation and measure purchasing power. So these 8 groups. So nearly half of our spend is on housing. So it's either on if we rent a house or mortgage, or some people pay a mortgage, or some people don't even have a house. They may have a mobile home. Some people have but they do get a lot of quotes from a lot of sources. I think if you're homeless, you probably aren't going to be part of this equation. But so housing is nearly half of our spend, because it's not just rent or mortgage. It's also your bills, gas, electric, water, cable. I think that's all part of housing. And I think it's also I think like maintenance, like maintaining your lawn, maintaining your backyard. I think that's part of housing, but I'm not sure. I didn't really dig that deep into this. Just trying to keep it high level. Transportation. So a car, gas, insurance, Ubering, that's all part of transportation. So that's the second biggest spend, because you kind of need these two. You can't really live without this too, food. So you need people. These are kind of basic necessities. These three. Medical comes after that. Hopefully you have enough money for medical. So food and beverages is 14%. Your groceries at the store, your if you go out to eat, lunch during lunch break, if you go for drinks, go to a bar after work. Medical care, so that includes medical insurance. It also includes what you pay beyond insurance. Some people don't have insurance, so what they pay is also part of this. Then the next biggest is education. So college, and then private school. Some people pay for private school. And even if you go to a community college, or even if you get a scholarship, you still have to pay sometimes for books. You have to pay for maybe tutoring, and then some people don't even spend much or close to nothing after these first three. Some people don't even spend anything in here because they don't have anything left over. But if you do have things left over, 5% on recreation, vacations, going away for a weekend or overnight, or just going out and partying with friends, apparel, clothing, different accessories, I guess. And then other. I'm not sure what's in the other. It's just a catch-all for everything else. So that's a CPI. So your CPI may not go up. Like you may see inflation going up 7-8%, but if you own your home, and you own your car, and you live pretty frugally, you might not, your bills might not increase that much, because you do pay more for electric and gas with higher inflation, but your biggest cost is already kind of fixed if you own a home. You do pay more in taxes, but you don't pay, rent or mortgage. Unemployment's an interesting one because it seems kind of obvious, like what unemployment is, and it's kind of obvious, but it's not just people who can't work. It's people who are out of the workforce for whatever reason. So, I mean, the simple way to say it is someone who is unable to find a job. But it's not anybody, it's not if you have a 13-year-old kid, they're not part of that equation, because even if they're looking for a job to make side money, they're not considered eligible. So, the higher the unemployment rate, the more distressed the economy is in. Not 100%, but it's much more likely that the higher the unemployment rate, the worse will be, and the lower the unemployment, the better it will be, generally speaking. So low unemployment may signal a strong economy, or it could just signal a lot of people who gave up on looking for work. Because if you give up, I'll show you in the next slide, the calculation, you're off the radar. But the U.S. And other economies offer insurance if you're unemployed. So they give you unemployment insurance to get you through the hard times. And obviously some people will take advantage of this. Let me know in the comments. I'll do some DCF videos also. And I'm sure some people complain, oh, it's not fair that people get unemployment insurance. That's my hard-earned money. If you were unemployed, you would be extremely thankful there was unemployment insurance to help you feed your family and pay the bills. But no matter what happens, people will take advantage of things. It's not like you wouldn't say, oh, it shouldn't be illegal to commit a crime. Like if you steal someone's car, you shouldn't get in trouble for that. That shouldn't be a crime. But it's like we have these rules, and no matter what you do, people will take advantage of things. People will commit crimes and not get caught, or they'll get caught and not go to jail because they have a good lawyer. That doesn't mean crimes should be. We shouldn't penalize people for committing crimes because some people get off. More people are hopefully getting convicted for crimes. Fubo. Okay, yeah, I'll do that one. Just like for unemployment insurance, if 3/4 of the people are using that unemployment insurance to feed themselves and their family, that's a good use of unemployment insurance to keep them, alive and keep them somewhat in a good state until they find a job. If 25% of people are taking advantage of unemployment insurance, then unfortunately, they got around the system, but you shouldn't penalize 75% of people because 25% take advantage of it. Because no matter what you do, like if you have a sibling that still lives at home with your parents, like you found a job, you're supporting yourself, but your brother or sister still lives at home, they're 30, that doesn't mean you should quit your job and move back home. Just people, this is how people are. So the calculation is unemployed people over the labor force, and we'll do the calculation later. So only people in the labor force are counted in the unemployment rate, and that's led to some controversy because that kind of makes our unemployment rate look good. I'll show you in a minute why. So those who have given up looking for a job are not part of the equation. So when you exclude those people, it does make it look a lot better than it really is. So maybe 10% of people are unemployed, but the way the U.S. calculates it, it looks like 4% are unemployed because those 6% are just not even calculated. So a misconception is unemployment is not measured by the number of people collecting unemployment insurance. That is information out there, but that's not the equation. I'll show you how they calculate it. And I didn't really know actually till I Googled it just before. So the government, it's similar to the census. They send letters out to 60,000 random households, which if you know math and you know like statistics, that's actually a really high number to get a good statistical information. You just have to like if you want to know if there's if you go to a football game and there's 50,000 people in the football game and you want to know what percent of the people are male, what percent are female, you don't have to ask all 50,000. I don't know the number, but it's something like 800 people. And if you ask 800 people, I'm just making it up, but it's something low like that the chances of you getting within like a 3% range of male and female are like 95%. So you don't have to ask every household in America if they work or not. If you survey X number of people, and they survey a lot more, so they have like a 99% chance of being accurate. Assuming the people answer accurately and not lie on it. But that's a different story. So they sent out 60,000 random surveys to people. Of course, not all 60,000 will respond. I don't know how they get them to respond. I wonder if they contact them before and ask them to be part of the survey, or if they just send a survey out, or if there's any type of like benefit to the person responding. Probably not. And then the households. Okay, so if someone, let me rewrite this. Someone in the labor force is defined as actively seeking a job. And that's the big differentiator. And then someone with no, I didn't write that well, but okay. So someone has no job and claims they're not looking are out of the labor force. They're called discouraged workers. So it's just pretty much what they do is they'll send letters out to 60,000 households and say, I don't know how many responses they get. It doesn't matter. Say only 40,000 respond. But let's say of the responses, there's 100,000 people who are 16 and over in the survey. So you might get it. And if you live alone, then you're just one person. But if you have 5 people in your home, you, your wife, and your 18-year-old son, you 3 are part of the survey. That's interesting. I've been outperforming the S&P 500. I'll show you on my E-Trade. I was really happy because I didn't even know E-Trade had this, had a way for you to see how you perform against the S&P 500. But I'm beating it by quite a bit. I'll show you in a little bit. It only goes back up to 3 years, but I'll show you that in a little bit. So let's say they get 50,000 letters back from these 60,000 households, and 100,000 people are 16 or over. So there are 100,000 people who have a chance of being part of the study. But of those 100,000 people, 25,000 people claim they don't have a job and are not looking for one. And I mean, it could be the 2 people live in a house could be 80 years old. I mean, that's a perfectly fine reason to claim, I don't have a job. I'm over 16. I don't have one. I'm not looking for one. I'm retired. Or they can be 50 and retired, or they can be disabled. There's a lot of reasons someone can claim, or it could really be someone who was looking for a job and then after a year just totally gave up and is trying to like maybe start their own business or just sits on YouTube all day and does nothing, whatever the reason is. So now they knock out 25,000 people. So the remaining 75,000 people now claim to be active members of the labor force, meaning they're above 16 looking for a job. Or they just have a job. And the only way they could be part of the labor force is either they have a job or they're actively looking for one. Or it might be both. You might have a job and actively looking for another job, but you're employed part of the labor force. So if that's the case, so of these 75,000 people, let's just say, for instance, on the surveys they got back from the people. I wonder if they do it online. I spent most of my money on male escorts. Who hasn't, right? Say of these 75,000 people, 70,000 people claim to be employed. 5,000 people are unemployed and looking. So the unemployment rate is 6.7%. 5,000 over 75,000. That means 93.3% of the people are employed, gainfully employed. So that, if you want to get, I guess, the real inflation rate, they call it, you can say, well, Let's include the 25,000 people who aren't part of the survey because they're unemployed because they, for whatever reason, gave up or maybe retired. So that's 30,000 people over 75,000 people, or actually, let me see, equals 30 over 75. So our unemployment rate is 40% in this case. That's a high unemployment rate, right? But I think you can narrow it down more. Let's say 25,000 people are out of the survey. Um, 70,000 employed. I don't know. I'll just say it out. So 5,000 are looking. Actually, I did that wrong because I didn't include it in the denominator, the bottom of the equation. So if there was originally, say, 100,000 people and 70,000 are employed, right? That means unemployed is so 30% unemployed. If you include the 25,000 people who opted out of being part of the equation, but 25,000 people opted out, but that doesn't mean all people are even eligible. Because I think if you're above 60 or whatever age you want to pick, 55, 65, I think it's fine to be out of the equation if you say you're retired. Or if you have something wrong with you physically or mentally that you're unable to work, I don't think you should be part of the equation. So maybe out of these 25,000, maybe 10,000 can actually work. Like they just kind of gave up for whatever reason. They're just sitting at home with their parents. So let's just pretend it was 10,000. So I think the unemployment rate should be 18%, not 7%. But that's just, but they do provide the real unemployment rate equation. The people who claim they're not looking for a job anymore, but should be looking for a job because they're either of a good age to look. This last slide, I didn't really do much with it. I kind of got tired of doing this presentation, and then I went on to make my Airbnb video. Airbnb looks really good. So GDP, gross domestic product, is the value of all finished goods and services made within a country. So if you sum up everything that was made in our country, say for 2023, all real estate that was made, all cars, all phones, all mouses, all microphones, like everything that was made in our country, and summed it up. That's the value of the country. And of course, we have the highest GDP. So it provides an economic snapshot of a country. It's used to estimate the size of an economy and its growth rate to see if an economy is growing or detracting. And it's a key tool to guide policymakers, investors, and businesses in decision making. Because if you see that GDP is going up, and then inflation is going, all these things, you might be able to extrapolate which sectors might be better to invest in, or which sectors might not be as good to invest in. Because if you think about it, really high inflation, it affects it affects inexpensive products. Like, so stores, that's like the dollar store, like when they have really high inflation, I think they even changed it, right? It was the $1.25 store now, because things you couldn't sell for $1 anymore. But when inflation gets really high, it makes those cheap things really, really expensive, because if those cheap things go up 10, 12%, it's noticeable. But those really high-end stores that sell like $10,000 purses, inflation doesn't affect them as much for some reason, because people are already overspending and they know it's expensive. Because I remember those really high-end stores were, when inflation was like double digits, or almost double digits, they were reporting pretty decent earnings. So it's a pretty boring presentation, I know, but I think this stuff is kind of interesting. Here, let me pull up my E-Trade, and I'll show you what my return is. It takes a long time because I have to enter all these codes in. Yeah, I just noticed it actually the other day, that they give you the return of your investments against the market. Performance. So year to date, okay, this is all my accounts. I have one account that's up like 150% because it's only invested in one stock, Nubank. So year to date, which is, it should be the same number as 3 months, because, oh no, because it's only like, it's less than 3 months so far year to date. It's only 9 weeks. Okay, so year to date, the Dow Jones is up 3%. I'm up 15%. This is all my accounts combined. 3 month, I'm up 18%. Dow is up 7%. 6 month, I'm up 20. Dow is up 12. So we were tracking each other, because I have a lot of the S&P 500. Oh, they compare it to the Dow. Oh, maybe I'll help. Oh, I didn't even see this. Okay, I'll just compare it to these 3 indexes. So in my brokerage accounts, I'm up 15%. The S&P is up 7%. So if I only invested in an S&P 500, like I put 100% of my money in spiders, I would just be up 7.4%. I do have a lot in spiders, maybe 20% of my money in spiders, but I have a lot in Berkshire Hathaway, Meta. I have Energy Transfer, Johnson & Johnson. So yeah, so that's year to date. 3 months, I'm 18%. NASDAQ is 12%. 6 months, I'm 20. NASDAQ is 17, so I'm close to the NASDAQ. 1 year, actually the NASDAQ is beating me by a little bit. NASDAQ is 44, I'm 40, also 44. S&P isn't doing as well. 2 years, I'm 36, the NASDAQ is 21. 3 years, I'm 50. So I'm really, the 3 years is the best one because it's more information. So I'm up 50%. I'm really happy because I was it was hard. I remember in 2021 to look at my portfolio because it was down like 20%. The market kept going down. Now I like looking at my portfolio, but when it goes down again, who knows when it's going to go down? I'm going to hate looking at it. I was going to. Yeah, I can't remember what I was about to say. So the S&P, I wonder. Well, you could only do 6. So the Amex Composite Index is up 70%. Amex Computer is up 79% because of NVIDIA. This is what I was thinking about. I had a family member where I was investing their money, and I put it all into one stock, CrowdStrike. And they were, let's see. Let me see where I bought it. I bought it on I bought it right here. I bought it March 2022 at 197. So I got it right here at 197. And then after a few months, I was up like 25%. So I was really happy with that. And then it came down because the market just kept coming down. And they weren't annoyed because they weren't even looking at it. I don't even think they even knew how to log in. But they ended up. I was down like 10% when they sold out, and they gave it to a professional. But look how well it's done. They sold it around maybe 150, 140, and now look at it. It's over 300. I was like, oh, you could have made all that money if you would have just held on. And the financial advisor has all these crappy, high dividend, low returns. They're not even, I think they're still flat for a year and a half now with that financial advisor. But I actually didn't want to do their money because I was like, I don't feel comfortable because if you lose, I'm not going to feel right, and it's too much pressure. So I told them, like, I'm okay if you want to switch it over to someone else, even though I made money for them in the past, but that's a different story. So what's anybody have any tickers you want me to look into? Fubo TV. Fubo. Zim. Zim's a good one, right? We all remember Zim. Somebody got mad at me. He gets really mad at me when I make a video on Zim. He's like, I lost all that money because of you. But I just do videos on like 1,000 stocks. So I'm not going to invest in 1,000 different companies. So I can't. I just give my opinion on so many companies. So it's your decision if you want to invest in it. But I would never invest in Zim. It's too volatile, the industry. Okay, Fubo. Am I still? No, I'm on Fubo. $168, $500. Sheesh, it really came down. 168. Fubo. Okay, this is going to make it hard. They don't have. I can't do my free cash flow model because they don't have growing revenue. Positive free cash flow. So I'll just do. This is good. Yeah, I mean, it is hard. It's hard to value a company with negative numbers every single year. I can do it, but hey, D. Lopera, thanks a lot. Thanks for joining. Pretty big revenue growth. Earnings 1.6, 1.8, 2.2. 1.6, 1.8, 2.2. So I have to kind of estimate. That's probably too high of an estimate. Let me get a higher whack. Okay, I mean, this is a kind of tough one, but I'm at $4.12. They're trading at $1.68. That's assuming they become profitable, which they haven't done yet. Can you quickly explain how some companies have positive free cash flow but negative income? Yeah, I mean, it's so you can have so a company can have net income save $1 million, and they could have free cash flow of negative 200,000. Okay, so free cash flow is operating cash flow minus CapEx. So operating cash flow, so I have negative 200,000. So maybe they have a few things. So free cash flow is operating cash flow minus CapEx. So operating cash flow could be a lot lower than net income. And the main reason it's a lot lower is stock-based compensation. Because especially smaller companies that don't have a lot of cash, they pay employees with stock-based compensation. So you have to add it back on the operating cash flow. So it makes like but in this case, a likely reason for this is they're just spending a lot in capital expenditures. So let's just pretend this company had $1 million of net income but operating cash flow is $100,000. But they spent a lot in CapEx. So they're looking to grow a lot and scale. Especially companies like manufacturing companies, they have to spend a lot in CapEx because they have to build factories. They need machinery and equipment. So that's usually, is that what we said? Oh, but you said the opposite. You said positive free cash flow and negative net income. Okay, so that's one company, but so this is the opposite of what you said. That's positive. So what if it was the opposite? Another company had negative 200,000 of net income. So this, and the main reason a company might have a lot of like a negative net income and a lot of cash flow is because they pay a lot of, like I said, the stock-based compensation thing. Because if they have revenue of say they have revenue of 3 million and let's just say cost of revenue of 3 million. So it looks like they have a gross profit of 0. But if they pay a lot in stock-based compensation, let's just say they have 2 million stock-based compensation, so their net income is negative, but they have to add back the stock-based compensation. I guess to simplify it, it's just a lot of non-cash expenses on the income statement, because non-cash expenses bring down your net income. Like if you have write-offs, like goodwill impairments, things like that. But if you give me an example, like a company, then I could show you exactly in that company. It'll make a lot more sense, maybe, than trying to come up with numbers. Like for so you said positive free cash flow, negative. Okay. So, okay, snow. Okay, I'll show you snow. Goodwill is brand new. Is like brand new. I don't know what you mean. It's from acquisitions. Goodwill is the premium when you acquire another company for more than the company's worth. The additional amount is goodwill. So they have negative net income. So they always have negative net income. So in the most recent quarter, I know. So in the past 9 months, they had negative 668 million of net income. So a net loss, 668. Okay, so they have a net loss of 668. But the way you calculate free cash flow, it's operating cash flow, 500 million. Okay, so net income. Net income. Okay. So operating cash flow, 503, 3542. CapEx. I guess this is part of CapEx too. Let me see if they also list the 454, 424. Snow has bizarre SBC. Yeah, that's why. That's the main reason companies, these types of companies. Free cash flow. This is for 2022 though. In the chart, okay, I guess they just this is for the just 9 months, but I'll just do it anyway. So negative net income, positive free cash flow. Because yeah, stock-based compensation on the income statement. On the income statement, this negative 666. So this $800 million expense is part of it's part of this cost of revenue. It's part of this sales and marketing, part of R&D, because it's tied to the employees who work in marketing. It's tied to the employees who work in R&D. But stock-based compensation is not a cash item. So even though it brings down your net income, which helps because then you don't have to pay any taxes, the company doesn't have to spend cash because it's their own stock. So it doesn't cost them anything. It does dilute shareholders, but it doesn't cost them anything. So yeah, so most of the time it's SBC. But if it's a mature company, like a profitable company, then it's much more likely to be an asset impairment, like goodwill impairment or just like a fixed asset impairment. Yeah. Usually that's the main reason. But if it's a more like a larger company, like a large company, like an oil and gas company or a manufacturing company, then you would see a ton in depreciation because they have a lot of fixed assets. But yeah, that's a good question. Goodwill. So goodwill, say I wanted to acquire a company for $1 million. Say I want to acquire them, and the company say my company, and then yeah, the company I want to acquire. Say my assets are $5 million. And let's say their assets are $2 million. And my liabilities are $3 million. And their liabilities are $1.2 million. So that means my equity, because equity is assets minus liabilities, right? Is $2 million. And their equity is $800,000. So before the acquisition, this is what my company's balance sheet looks like. This is what the, I'll just call it company X. This is what I want to acquire company X for $1 million. After the acquisition, I would take all their assets, because I'm going to give $1 million to the owners, and that's their money. That's not part of the company anymore. They take that money, put it in their pockets, and do whatever they want with it, the $1 million I give them. Post-acquisition, I now have $7 million of assets, because I have my 5 plus company X. I take their $2 million. The assets could be it could be accounts receivables, it could be inventory, it could be fixed assets. I don't know, whatever it is, it doesn't matter. But that's their total assets. And I also take their liabilities, because when you acquire a company, you have to acquire all their debts as well. So I have now $4.2 million of liabilities. But remember, I paid $1 million, so I have to minus the $1 million. Did I minus $1 million? I have to minus $1 million from my assets, because I have to pay that cash that goes to them. So this minus this equals $1.8 million. So 6 million minus 4 million equals 1.8 million. But I'm taking now my equity, it doesn't balance anymore. Because, well, maybe it's the easy way to say it. Because the company's only worth $800,000. Because when you acquire a company, you're taking their assets and liabilities, and I'm only getting $800,000 on my balance sheet. So I have to, it's kind of like a plug, goodwill. So I have to add $200,000 to goodwill. It's the difference between the it's the premium you pay when you acquire another company. Maybe I should just said that. Maybe it's just easier to say it. So they distributed the stock-based compensation throughout R&D. Yeah, whatever employees, I don't know. They probably do explain it. Yeah, so goodwill is just what you pay above what a company's worth. So if I acquired company X for $1 million, I would get $2 million of their assets, $1.2 million of their liabilities. Since that doesn't equal $1 million, I have to add $200,000 to goodwill, which is an asset. So actually, my assets would go up $2.2 million, not $2 million. I shouldn't have done that negative $1 million. That kind of just makes it more confusing. But so yeah, it's just a plug to make assets and liabilities equal. So yeah, so I don't know where the employees, what departments they worked in, the ones who got the stock-based compensation, but it's definitely going to probably be in some of these areas. But you could probably find it on the well, maybe I don't know about this report, but the 10K they probably have what makes up the stock-based compensation. So yeah, here. So of the 863 million stock-based compensation, 93 million is in cost of revenue. So those are like the stock for the employees who work on the front line. The employees who work in marketing, 226 million. R&D, that's where most of it is. I guess that's the most important employees. Whoever's usually the highly compensated, the employees that make the most money generally get the most stock-based compensation. And then G&A, general administrative. SBC, including the condensed consolidated, as of 10/21, total compensation costs related to unvested stock-based rewards was 2.9 billion, which will be recognized over. So they're saying 2.9 billion of stock-based compensation has not been recognized yet, because the only way a company can put stock-based compensation on their income statement is when the stock gets, when the employee receives a stock. Because if I hired you, of course I'm going to make it more confusing. If I hired you and I said, we're losing money, so I can't pay you a big salary, so I'm going to just pay you $100,000 a year. And you don't want that. You like, I make $200,000 at my current job. Well, I'm not going to go to your place for less. But I said to you, but I'm going to give you $150,000 of stock. That's what it's worth today. So it might go up. It might be worth $1 million next year, or it could be worth less. But right now, I'm going to give you what's equivalent to $150,000 stock, but each year you get it. So after your first full year, you get so maybe I'll just say, like, I'm going to give you 10,000 shares of stock for your first 4 years. But you don't get it until the year is done. So okay, this is the value. This is the value, shares, and the price. So I'm going to give you 10,000 shares of stock each year for your first 4 years to compensate you for taking a lower paying job. And you say, oh, okay, that's a good deal. And let's just pretend at the end of year one, because you knew you were taking $100,000 hit. At the end of year one, the stock is flat. It's $10. So you get $100,000 worth of stock after your first full year. So you're happy. You at least you got back what you originally thought you would get. And then it goes on to the income statement after year one, $100,000 of SBC. After year two, when your second year is done, say the stock goes up to 19, you're like, yes, this is awesome. I mean, it's your stock, so you can just sell it right away. And I've done that before. When I get stock, I'd sell it the next day, or you could just sit on it, just like any stock. It's yours. You can do whatever you want with it. So then it hits 190,000 on the income statement after your second year. So it only hits the income statement when the stock is recognized. Not, I don't show all your dollar amounts when I hire you on the income statement. It's only because you might quit before the 4 years is up. And also, I don't even know how much the stock price is going to be. What if it goes to $3? Then I saved a lot of money, and you're unhappy, but you don't hold it against me because you knew the risk. Yeah. So that's pretty clear, right? That was a good question. That's pretty clear. Stock-based compensation, net amounts. $862,517. So this is what shows up on the income statement. Capitalized stock-based compensation. The word capitalized means it's put onto the balance sheet, and it's held there until sometime in the future. So in your case, as a new employee, I don't capitalize anything. I just wait for your year to end. Like each full year is done, and then I give you your 10,000 shares. I don't know, whatever the price is in the open market. And it doesn't really matter to me too much. I'm just happy you signed on and took this deal. So I don't care if the stock goes up to $100 a share and you made $1 million, or it goes down to $3. Not that I don't care, but it doesn't affect me financially, really, because it's free stock. But sometimes it gets capitalized, which means it's put onto the balance sheet. That's usually due to timing delay of some sort. Maybe there's somebody else I hire and I have a different deal with them. But the goodwill, I think I made it too confusing. It's just whatever premium you pay for acquisitions. It's only from acquisitions. It's a plug. It's a goodwill. Sometimes when they acquire companies, they break out the goodwill and they explain how they came up with the purchase. Was it? Okay, here. See, these are the kind of questions I like because it makes me think a little bit. Okay, so they acquired a company. Okay, so who are we looking at? Snowflake. So in March 2022, they acquired this Streamlit company, a private company. The company has accounted for this transaction as a business combination. The acquisition date, so they paid $650.8 million for this company. And this is how they paid for it. They paid cash of $211 million and common stock of $438 million. So you would see the cash on a statement of cash flows. because that's how much cash they spent for this acquisition. But common stock wouldn't show up on a statement of cash flows because it's a non-cash item. So the value of the company, this is how they accounted for the value of the company, $651 million. So cash, 33,914. They have an intangible asset of 150. And they have liabilities of 659 minus 26911. So the value, according to the balance sheet value for this company is because this company's at least what Snowflake is receiving, they're paying $651 million. They're receiving $34 million of cash. I think the reason they're acquiring this company is the intangible asset they're receiving. I don't know exactly what this company does, but whatever software or whatever something they have is of value to them. So they're paying $150 million for this intangible. This is going to go on their balance sheet, on Snowflake's balance sheet. So they're only actually receiving $156 million of assets, of value from this acquisition. So the difference is goodwill. So the difference, whatever's okay. So they're receiving 156 million of real value onto their balance sheet. They're paying 651 million. So the difference between 650 and 156 is goodwill. So goodwill is just a plug. It sits on the balance sheet. It's a meaningless asset. There's no value there. You can't sell it. You can't do anything with it. But you have to account for it because companies generally acquire companies for more than they're worth. Why? What's so low? Nike's goodwill? You can only get goodwill through acquisition. When you look at a company's balance sheet, like Apple has no goodwill on their balance sheet because they don't acquire companies for more than they're worth. Goodwill is only the companies they acquire, not the company, not the actual company. You can't internally generate goodwill and put it onto your balance sheet. You can only get it when you acquire another company. If another company acquired Nike, then we would find out the real goodwill of Nike. But Nike's not going to put their own goodwill on their balance sheet because you can't do that. What are your thoughts on Vision Pro? Oh, is that Meta's product? Or was that a company? Oh, Apple. That's Apple. Apple Vision Pro. I don't know. I'm not too familiar with it. It's expensive. I mean, Apple has to get into the AI game. They have to. Hi, country. Thanks. Because I think they're kind of like falling behind on keeping up with like the new stuff in the market, mainly AI. So that's why the stock has been declining. So even if they don't make money, they just have to say they're doing things in AI because the stock will go up just by if you say the word AI, your stock will go up because investors will think, oh, this company is part of AI. So Apple is actually, it's 10 months and Apple stock hasn't moved in 10 months. It's back to where it was 10 months ago. And it's down. It's down like 15% year to date. So yeah, they're just trying to get an AI gain. Hey, Dr. Jones, I don't know, but it's a good idea. I'm sure it'll be a great product because they make really good products. So, I'm all Meta. So that's not. They don't have good reviews though. That's not good. A lot of ones. I wonder why there's so many ones. What is this supposed to be? It's front heavy VR set. Please remove these goofy eyes from the front on the headset. Okay, Apple, if you think I'm spending $3,500 on a Meta Quest 2 ripoff, hell to the no. Let's look at the comparison, shall we? The Meta Quest 2 and 3 can also do hand tracking. I kind of like have Apple, my wife's account, Meta in my account, like Amazon on my wife's account, Berkshire on my account. So I kind of like balance the two. But unfortunately, my portfolio is up so much because mainly Meta, but also Berkshire. Yeah, I'm up like in 3 years, like double the S&P 500. Were you guys on? I showed my performance the past 3 years in my E-Trade. I don't know if you guys were still on. I could bring that up again. But there was a time I was lagging the S&P. So it doesn't matter if you're up or down today. When you sell it, you want to be up. So like I was down 50, 60, 70% on Meta. So it didn't matter. It's just like if you buy your home for $1 million and then 2 years later, your home is worth $500,000, it doesn't matter unless you sell your home. But when you sell it, if you're selling it in 20 years for $2 million, that's fine. You just don't want to have to sell these. So in the past 3 years, the Amex Airlines is down 36%. Amex Airlines. Oh, the semiconductor must be up a ton. Oh, it's not. The Amex computer is up 78%. Semiconductor is up 70%. The semiconductor is up 70% the past year. I'm up 44%. Do you have any accounting books or anything, sources that help with accounting? No, I don't really. What I learned the most from, but I took the CFA. Just the first level. I took the first one. I didn't do well in the second one, but that helped me a lot to give me a foundation. But it's a lot of like hundreds and thousands of hours of work. So it's a bit grueling, but I think the best way is just to like when you try to read financials, Google, like read Investopedia, read about the terms, because like this is what I did. Even when I started the channel, like there was some things. Even now, there's some things like I can't like give you a perfect definition of deferred tax assets, or I could explain it to you, but there's some like nuances to these things. It still confuses me. But this is what I did a lot. Even when I started a channel, I'm like, I know what cash is, short-term investments, and you should search, like you see short-term investments. Like, I know you probably know what it is, but you should actually look at the number. You see there 3.2 billion. You search for that number, and then you see what it really is. This is going to give you a lot more information. And you see it's a CDs, government bonds, commercial paper, corporate debt, mortgage-backed securities. So now you really know what it is. So if somebody ever asks, and if you're not sure what commercial paper is, you just Investopedia, I think, is the best. It's the clearest. Then you just search commercial paper and you read, like, commercial paper is unsecured short-term instrument issued by corporations. That makes sense to me. But if you're, if you're not sure what unsecured means, and this kind of like, but you can't do it once. You have to do it like 50 times. Like, you got to probably have to Google commercial paper next week when you read it, because like you kind of forget what it is, or what does unsecured mean? What does that mean? And then you link, okay, it's made without an asset given as security. It's a little vague. If you want, unsecured refers to debt or obligation that is not backed by any collateral. But once you read more, then you start to see examples. So unsecured debt is a credit card because there's nothing backing the debt. If you default, the credit card company can't take anything. They could just hurt your credit score. Secured debt is like a mortgage loan. When you go to the bank and get a loan to buy a home, that's secured debt, because if you default on the debt, your home, the bank can take your home. So your home is securing the loan. So this is kind of like how I did it, at least. Because when you read a book, you absorb maybe like 5% of what you're reading. You have to kind of put into practice. But any more tickers? But yeah, Apple, like, they're like 70% of their revenue is the iPhone, so they're really heavy iPhone. So that's really the most important thing, at least just to maintain their business. And YouTube videos are helpful if you want to learn about a topic, but it seems like, like you could spend an hour learning about what commercial paper is. Like, it seems like kind of a never-ending process, because you're like, you always forget. Oh, I forgot what collateral means. So I forgot what. So you always have to keep going back, and then eventually it clicks. So collateral is something they can take from you, like a home or car. Yeah. I mean, collateral, or it could be something else. I mean, you can, if you wanted to borrow money from a friend, you can give him your wife as collateral, if he wanted that, or you can give like your watch as collateral, or something, because he wants, or you can give something that he doesn't care about. Maybe it's like something personal to you, like a piece of jewelry your grandfather gave you, but it's only worth like $20 maybe, but it has a lot of sentimental value to you. So maybe that's collateral. And secured loans carry lower interest rates. Like a credit card has a higher interest rate because it's unsecured. So that's why credit cards are like, 15%, and a mortgage is like 6%, because it's less risky, a mortgage loan, because there is something they can take if you don't pay. Yeah. Damn, I have a call at 1. I'm looking into getting another Mathnasium franchise. So I have a call with Mathnasium. Somebody wants to split one with me. I had one for almost 10 years. I'm so bored. And I guess it was so much fun having one. So I'm looking into it again. It's like $120,000, $130,000 to get it up and running. And then there's, of course, risk that it might not make money, but hopefully it's a great business model. Are you guys familiar? Have you looked into any franchises? They have a pretty good franchise. I don't think many people default. It's hard to know if a franchise is successful because it's like some of the information is not public usually, unless it's a McDonald's franchise, I guess. But most companies aren't public, so you have to kind of. But the thing is, like, if you run a business, somebody can lose money running a business, and then somebody takes over and makes a lot of money. So it's a lot to do with the person running it. Of course, you need a product or service that people want, but I think the most important thing is the person running it. That's why certain CEOs always seem to make companies successful. Other CEOs just don't do a good job. I sold all my alts. The Fed is about to hit the delete button on those. BTC 100K coming soon. Alts. What is alts? Is that like a crypto thing? Alt. What is alts in crypto? Alternative coins. Okay. All coins is a term used to describe all cryptos. You sold all your crypto. Okay. It looks good, crypto, right? Bitcoin hit its all-time high, right? Recently. Dogecoin, how much is it at now? 12? 18 cents. Wow, it's come up so much. I hope Dogecoin Millionaire didn't sell his Doge. Remember Dogecoin Millionaire? He bought it at 4 cents and he had like 2 million. And then it came all the way down again to like where he had next to nothing. Wow, it's coming up. I thought it was never going to come back. I remember it was like 4, 5, 6 cents. Well, I have this call at 1, so unfortunately I have to cut off the live stream. But I'll try to do tomorrow. Thanks for joining. I'll talk to you later.